Welcome, Michael.
Thanks for having me on the program, Elliot. I love your background, by the way.
Thanks so
Makes
much.
me makes me jealous. You're talking to me. I'm in New Jersey, and we have I think the low this morning was like 30. So I'm very jealous.
Okay, yeah, it's overcast today. It's like 50 degrees or something. But anyway, so I'm just a huge fan of yours because you're an active manager and you have like a very sophisticated, intricate 20-point model. So, and you listen to the data, which is just very like valuable nowadays, right? You're not a perma anything. You're not perma gold. So what is this kind of active strategy and model telling you right now?
Well, first of all, thank you for understanding that. It's so critical. Maybe 40 years ago, you might be able to say, well, you can buy and hold the stock market. In just for reference, in the year 2000, which was an epic bubble point where the NASDAQ bubble peaked in March of 2000, the total market cap of equities was 140% of GDP. In 2000, in the later stage of 2007, just on the precipice of the Great Recession, which began in December 2007, total market cap of equities was 100% of GDP. Now we're over 200% of GDP. And if that's not scary enough, back in those other times I just mentioned, there was never any such thing as a negative yielding sovereign bond. You never got paid to borrow money. So you have a bond bubble, a equity bubble, and as we were talking in the pre-interview, we have a massive real estate bubble too. It's an echo bubble, maybe not quite as bad as it was in 2007 because the underwriting standards are higher. But if you look at home price to income ratios, they're back at the apex. So you can't just buy and hold anything any longer. So you asked a very good question, and it's what I think about every day with the 20-point model. So I have 10 components for inflation deflation dynamic and 10 components for the growth/recession dynamic. And I was prepared all last year up until really a few days ago. I was heavily invested for the rate of change in growth and inflation to accelerate rapidly. And I especially thought that would be the case in the latter portion of 2020. So the model predicted, thank God, it predicted very well the start of the pandemic. I didn't understand why things were telling me to get more cautious, but they were telling me to get more cautious. I assumed it was because of this pandemic, but at the point, I didn't know if it was going to be, Ebola or the swine flu, or was it going to be the Black Plague? I had no idea. It could have gone either way. I guess we ended up someplace in the middle, but it said to get more cautious. I went short the market. I went long again. I went short the market in January and February, went long again in April. So I had a very good year last year. And this year we started out pretty well too. We didn't have such a great April because that was the transition phase. That was the transition phase to what I believe will be not a recession right away, not deflation right away, but just a slowdown in the second derivative of growth and inflation. So just so everybody understands that. So instead of growth being, running at 6%, it'll be more like 3%. That's all it's saying. It's not saying you're contracting in GDP, just a slowdown in the rate of change. That's all it's saying. So what does that mean for investment? It means instead of buying banks and shorting bonds, I sold that and I closed out the short in the bonds. That's all that means. So I'm more in the more dividends and stocks that can appreciate even when the economy is not rip roaring strong. That's all.
Okay, interesting. So yeah, it's a very crazy time, right? Because we just had rates kind of spike and people were scared for a second, right? Oh no, all of a sudden there's going to be this bond collapse. The Fed's going to have to pump on some, serious yield curve control. And obviously I've heard you say that they've been doing yield curve control for the last like 10 years, which they have, but even worse, right? To keep the bond yields down.
A cap on long-term rates, which they didn't do.
They didn't need to because bonds haven't really spiked. So I guess interest rates kind of drive everything. What do you see happening for interest rates?
So, boy, I can tell you this year, I'm surprised I haven't been on your show before. This is a real, you have some of the best questions I've been asked in a long time.
Thank you very much.
So that's not, it's crucial to understand the dynamics. Let's just talk about the yield curve spread. So what is the spread between the 10-year note and the 2-year note? These are the things that I look at. For a while, I have to be honest, I thought that the 10-year note could go to 2%. That was my belief. And I thought it would get there around June, just because of the base effects that are going to be in effect. The data that's going to be reported for April, which will come out in May, for non-farm payrolls. We still haven't seen it yet, Elliot. We haven't seen the over 1 million jobs created in the leisure and hospitality sector. That's still coming. Retail sales booming, but we've had some pretty good earnings. We've had a blowout retail sales, and we even had a very good trend in initial jobless claims. But that's still not getting the bond market to the point where it's anywhere near 2%. In fact, the benchmark Treasury is 1.65%. As of this recording. So again, this is one of the things I look at. One of the reasons why I'm starting to, a bit earlier than I anticipated, starting to move from a more disinflationary posture and a slower growth posture than I was before. Simply because I don't think the 10-year note is going to get to 2%. And you could say to yourself, well, a lot of people, and you said it so beautifully in the beginning of the program, like, I'm not one of those investors who says, the bond market is going to implode someday. I wrote a book about it. I believe it, but I'm always going to be, short duration, or gold's going to $10,000 an ounce, so we're always going to be long gold. You just can't be a thematic stop clock. You just can't be that kind of investor any longer, because things are just moving too quickly. And in my opinion, this is my opinion, based upon the valuation metrics that I mentioned before, not only total market cap of equities, but if you look at price to sales or median PE ratios, 10 years from now, it's probably going to be the case where you see the change in the S&P is not going to be very far from where it is right now, Elliot. But what does that mean? That means should we just all sell and go away? No, I think there's going to be a major drawdown, at least one, maybe more than one, between here and the end of the next decade. So that means you should be short the market, net short during some disinflationary, deflationary, depressionary cycles, but then also long when you see the next iteration of a massive QE program, which includes universal basic income, which I think is also coming. So massive busts in inflation, and then rip-roaring stagflation is coming in the next decade. And you have to be on the right side of that if you want to make any money.
Yeah, absolutely, you do. That's why I like your active strategy. So, but thinking about like right now, so if you see kind of a deflationary environment, slow growth, I mean, we've kind of been dealing with that for it seems like since the 2008 crash, right? Anemic growth and QE, seems like we're kind of in that same cycle. So is that bullish stocks?
Okay, so I always look at the rate of change of things. So we saw in March of 2020 to March of 2021, the federal government borrowed $6 trillion. Yep. $5 trillion of that was monetized by the central bank of the United States. In other words, they just sent checks out to corporations, to individuals, to state and local governments. That's going to change in the latter half of 2021. I mean, even if Joe Biden gets past the infrastructure package, which is going to be somewhere in the neighborhood of maybe $2 trillion, it's going to be spread out over a decade. So, a couple of $100 billion a year is not equivalent to $6 trillion. So I do see the rate of change in inflation and growth slowing pretty significantly latter portion of 2021, and especially in 2022, because you just said, well, QE is still occurring, correct? But we have $120 billion of QE per month going on right now. I think that ends completely sometime in the first half of 2022. So you're going to have a fiscal cliff, because you're not going to get any more checks mailed to people in the size that they've received over the past year. And you're not going to have banks having $120 billion a month removed from their balance sheet and replaced with this high-powered base money. This is Fed credit. They can go out and buy more bonds. They can buy stocks. They can buy real estate. They can make loans. That's all going away. So the rate of change is crucial. It's what I predicate my model on. I think you're having, I'm not calling for a depression yet or a recession yet. I'm just saying the rate of change in growth and inflation is going to slow a little bit now, but a whole lot more next year and into later part of this year and into next year. And that's a big influence as to what style factors, what sectors, what asset classes you own and what weighting.
I really like that, and I totally agree with you because I don't think people are factoring this in. The stimulus is going to slow, but I don't know if you've heard the analogy of like the U.S. economy is like a drug addict where it just needs more stimulus. To like
the heroin addict is bigger and bigger doses of drugs.
Exactly. So it can't handle a slowing of stimulus, right? So that would be very bearish for risk assets in the short term.
Well, Well, here's the thing, and let's just create the picture again. Let's just dovetail about what I said about the valuation of equities. It's never been anywhere close to this. It's 100 percentage points higher than it was prior to the Great Recession. That's the total market cap of equities to GDP. That's a big difference. So you need this constant infusion of new monetary fuel to keep things going. And one of the things I look at is the LIBOR OIS spread and the junk bond spread to Treasury. So those two things I look at that let me know when the credit cycle is starting to experience stress. That's going to be crucial because I believe that chances are very likely you're going to have another more than one Archegos event. So you see what this hedge fund blew up. It was 5 times leverage. It blew up and it caused billions of dollars in losses to Credit Suisse, a big multinational bank. And I'm thinking to myself, well, wait a second, is Archegos the only hedge fund that was afforded 5-to-1 leverage? And Archegos blew up in the best of times. It blew up in the middle of, the apex of fiscal and monetary support. What happens to these hedge funds when the monetary spigot gets shut off? What happens to these hedge funds when the fiscal stimulus dries up? I think you're going to have a lot of damage done primarily on Wall Street and in the junk bond market, in the Vanguard. And when the credit market dries up, this bubble will collapse in epic fashion. So again, you want to have a lot of flexibility in your investment process. You just cannot say to yourself ever, well, I have this modern portfolio theory style of investing. I'm buying and holding a mix of stocks and bonds and I'm going to be fine, because you're not going to be fine. And here's another thing I want to touch on before this interview is over, is that since this is the first time where we've had a triumvirate of asset bubbles, so real estate bubble, equity bubble, and a bond bubble, this is the time when you can actually make a case that the next iteration of a Federal Reserve QE program, if it occurs next year, let's just say the Fed has to once again bail out a bank, or the entire banking system for that matter, or the stock market, they'll already be at 0% interest rates on the Fed funds rate. And they will already be in some form of QE. And the question I have, and it is a question, I don't have an answer, but it is a viable question for me, is if the Fed then came with another round of QE, let's just say they're still doing $40 billion a month at the time when this crisis hits, sometime in the first quarter of 22, just for a supposition. Well, if the Fed says, okay, we're going to go back into $120 billion of QE, does that automatically turn things around? Normally, Elliot, it takes 500 basis points of interest rate reduction to pull an economy out of a recession. It took $85 billion a month of QE to reinflate the mortgage-backed securities market. But the thing that I want to impress upon you is these were supposedly emergency measures taken in the wake of the financial crisis, the Great Recession. They were supposed to be one-time events that would never have to be done again. Well, they did it again in 2019. Remind you that they did indeed in 2019, before there was anything, any global pandemic whatsoever. We didn't even hear about Wuhan, China. They went back into QE and lowered interest rates 3 times in the second half of 2019. And I believe there's a high probability that the next time the Fed, if they have to go back into QE in 2022, there's a high probability that the bond market starts to revolt, and the sovereign treasury market of the United States will suffer a lot of stress, because we just cannot at this point take on another massive multiple trillion dollar fiscal package that's monetized by the Fed. The Federal Reserve printed $7 trillion since 2008. Since January of 2008, the Federal Reserve printed $7 trillion. They added that to the monetary base. And our national debt is now 130% of GDP. It's $28 trillion. Annual deficits are 15% of GDP. In other words, what I'm saying, another recession, liquidity crisis, where the Fed says, "Oh, I got your back, Wall Street. Here comes the printing press, and here comes the fiscal package." Does the bond market, the long end, does duration begin to be bought, or does it sell off? And if it sells off, which is a high probability, you are not going to put this equity sell-off in check very easily. It could go from 30%, which I think 30% is the number where where Mr. Powell says, "Hey, we got to get involved and reinflate asset prices, reinflate equities." Does it stop at 30%, or does it go to 80% like it did in the wake of the great NASDAQ collapse from 2000 to 2002?
I love it. You're one of the only people that I've heard talking about a very risky kind of deflationary event that could impact the credit market. So just to map this out, I agree with you. Less stimulus is going to put a squeeze on this bubble economy. You see margin debt at historic highs, which is never a good sign. It's never been this high ever. So I agree with you. Risk assets look very vulnerable. So if they do, they're going to correct. The Fed's going to try to step in with some big bazooka, but you're saying they're kind of out of weapons. I mean, they could buy stocks directly, right?
Right.
They could do. They could obviously. If you're saying if bonds get out of control and the market kind of revolts, they could put a cap on rates.
They could try that. They could try to. They could say they could do that. Yeah.
They could try that. So obviously that's just going to debase the currency, insanely, like much more than it ever has before. Now, the question is, could that work, right? Could they sacrifice the dollar to keep this stuff afloat? And you're saying maybe not.
Well, they could try. I mean, I have no doubt that they will try. But what does the free market, whatever is left of the free market, what does that do in response to saying, wait a second, how can we possibly take on another, a $7 trillion, $10 trillion increase in the monetary base? And what does that do to inflation? You see, all other times, going back to 1987, Alan Greenspan and that crash in October of '87, when the Dow lost 23% in one day. It can't happen again because you have circuit breakers. But going back from that time to March of 2020, when the pandemic broke out, every time the Fed came in, there was a reaction in the long end of the Treasury market that says, "Hey, that's okay. I don't care if you I don't care if you render us even more insolvent than we already are. Take on trillions in debt. I don't care if the Fed monetizes it all and prints it all. I don't care," because in all of those times, from '87 all the way to 2020, we had no big problem with inflation. See, consumer price inflation was quiescent. And it's no longer the case that it's quiescent. You see year over year rates of change in CPI are going to be very, very high. So reported in May. And you see lumber prices going through the roof. Real estate prices are going through the roof. You see copper prices going through the roof. So there are a lot of issues now with inflation that didn't exist before. Think about the Great Recession when prices were plummeting all over across the board. In other words, I'm saying we had a 40-year bull market in treasury prices. So prices up, yields down. 40 years of that inculcation saying, okay, there's no inflation. There's no inflation. Fed can do whatever it wants. The government can, borrow whatever it wants. We are really going to test that theory. And I'm not saying I'm not saying they're not going to get away with it again. I am saying there is a high probability that they will not get away with it this time around. If it happens in 2022, because the tool shed is, the ammo is pretty much already been spent. There's no room to lower rates. And we are abusing the confidence in our currency and in our treasury market to the point where I think it could break the next time this happens. Possibility. That's all I'm saying.
No, absolutely. Because what are their weapons? I think UBI is a weapon they could do, right? They could say we're going to everyone
but Elliot, that's highly inflationary. See, that's why we didn't have inflation. We had inflation. We have intractable inflation in the equity market, intractable inflation in real estate prices. Go shop for a home in Naples, Florida, like I'm doing right now. The prices are up 80% in a matter of a few months. That's a fact in some areas. So you have intractable inflation in the things the Fed is trying to support. So junk bonds, which they purchased, mortgage-backed securities, which helped reinflate the housing bubble. They didn't purchase stocks, but when you give banks all these trillions of dollars, what do they do with it? They go out and gamble. They loan 5 times leverage to Archegos, and you see what they did with that. So there was inflation in asset prices, but if you go the route of universal basic income, you've actually circumnavigated the banking system. So we don't have to worry about whether or not, I gave JP Morgan, the primary dealer, base money. What are they going to do with it? Are they going to go and gamble on Wall Street, or are they going to keep it parked at the Federal Reserve, earning some kind of interest? No, you don't have to worry about that. Universal basic income means, hey, you're getting a check from the government. The government borrowed that money from the Fed. That is a direct infusion into the broader monetary aggregates and will serve to inflate consumer prices and will serve to depreciate the value of the dollar. I'm not talking about necessarily against the euro. I don't think Christine Lagarde is, Paul Volcker. I don't think the Bank of Japan or PBOC, People's Bank of China, are stalwarts in monetary frugality. But I will say that the dollar will lose buying power against hard assets in a big way. And that will cause inflation, and that will cause a lot of pressure upward on interest rates.
Exactly. So the next time the Fed has to step in the next credit crunch, things are going to crash. They're going to try to, lay on some tools, and it's not going to work. And they're going to be very highly inflationary, is what we're saying is most likely. So in the next credit crisis, right, when the whole market corrects a little bit and risk assets fall, including gold miners, will commodity linked assets be the buying opportunity of a lifetime? Most likely.
So it all depends, and this is prediction that made today about what's going to happen in the next year. So it's always, that's why I'm not a stop clock saying this is going to happen on this date. I can't do that.
Right.
So normally what you see in past recessions is you see that gold, which is real and honest money, it's not a commodity, it's a currency, that tends to go down and is used as liquidity. So when you think about Bitcoin, I don't know how you feel about it, but I'm on record saying that cryptocurrencies will be in the vanguard, leading the way down when this next liquidity crisis happens. Gold, and I how I'm known as a gold bug, although I don't like to be called one, but I do love gold. I think it serves a great place. It's a great placeholder of your wealth. That will go down. Commodities will go down. Everything is going to go down in this liquidity crisis. Now the question is, when the Fed tries to reignite this whole thing, is it more of a growth and inflation increase, or will it be more of the stagflationary variety? Right. I have to believe if they are able to reinflate the economy, it'll be stagflation in nature. And in that case, you want to avoid base metals and concentrate more on gold.
Okay. Wow. I think we covered a lot of deep issues. We covered, pretty much the next 3 or so years. I will definitely follow you to see what your model's telling you as we go along this ridiculously crazy roller coaster. And your book, right, about the crashing U.S. bond market, which is inevitable, some would say, or either the bond market crashes or the dollar totally inflates, right? Because it's either one or the other. So, I mean,
well, what is inflation, Elliot? Just briefly talk about inflation. I mean, the Austrians, the hardcore Austrians will say it's just inflation is increase in the money supply. Okay, well, then you have a problem. Define money supply. Is it base money supply? Are you talking about M3? Which, by the way, I don't want to leave this interview without making it clear that the Federal Reserve will no longer publish M1, M2, or M3. They didn't publish M3 for many years, got rid of that. Now they won't even publish M2 or M1, which I think is just shocking. I know you knew about that, but I mean, I don't understand why we're letting them get away with that. But they're trying to cover their crimes. Their tracks are being covered. But listen, you can't fool the bond market by not reporting M1 or M2, okay? Because we still get the Fed's balance sheet. We know exactly what they're doing.
Yeah.
And I do believe that the next time we have a crisis, you will see something more of a stagflationary variety, in that it will also have some form of modern monetary theory and universal basic income. And I think it will be in a big way. So it won't be something you have to approve every few months. They'll be say, hey, listen, if you make under this amount of money, you're going to get an infusion of a monthly check from now until whenever. And that will bring about stagflation like we've never seen before in this country, even much worse than it was in the late 70s. And of course, that I think would be enough to destroy the sovereign bond market of the United States. You'll see Treasury yields rise concurrently with a plunge in stock prices. That's a very real risk the next time this happens.
Right, just like it happened in the 70s, but you're saying worse now because they can't. Well, okay, sorry. Big question here. If that does happen, can they inflate away the national debt and then raise interest rates to kind of like cap it towards the end of that event?
Inflate away net. Well, when you say, I love when it's common knowledge that you can inflate away debt. Yeah. But you really can't inflate away debt unless your interest rate that you pay on that debt is fixed. If you have a floating rate attached to your debt, you can never inflate away your debt. I was listening to Jerome Powell. He was being interviewed recently on Bloomberg, and he's talking about well, right now we don't have a problem with the debt, but when the economy heals, we're going to have to address it because it's clearly unsustainable. Well, put up a chart of the trajectory of the U.S. debt to GDP ratio. I mean, it just goes like this. There's no stop. There's never a good time to address this. So the answer is, then I hear from other people in this field who manage money like me, who have an Austrian bent. Well, they're just trying to inflate it away. That's impossible unless you're able to put a cap on long-term rates. And it's a completely contradictory to say you can inflate in an unlimited fashion and still cap long-term rates. So, I mean, unless you agree that you're going to not only buy every sovereign bond in the United States that's ever issued, you're also going to buy every municipal bond, every mortgage-backed security, everything that has a yield or fixed thing, every utility, everything across the entire fixed income spectrum. Is that what the United States is going to do? Do an unlimited QE that trillions and trillions a day? Is that and that's going to solve the problem? Because unless you agree to that, you're going to have if you're only going to buy sovereign debt, are you also then are going to let municipal bond debt float freely in a context of hyperinflation? So it just doesn't work. Unless you have a fixed Like if you buy a house with a 30-year fixed interest rate and you have intractable or hyperinflation, then that's good. You can, your income will go up, but your interest rate on that loan stays fixed. We do not have a fixed rate with sovereign debt. It is a floating rate. And that's why you'll never be able to monetize your way out of this problem. In fact, no nation has ever been able to do it. Did Weimar Germany, was Weimar Germany able to do it? The Hungarian Pengo, Zimbabwe? Nobody's ever. You end up resetting the currency. You say, okay, we can't pay off the debt. Our currency has got too many zeros. We're going to wipe it all out in a deflationary bust. Just default on the debt, honestly, explicitly, and then start all over again. And hopefully that works, although it didn't work very well for Zimbabwe.
That is just so brilliant. Thank you so much. We covered so many important topics, including the end game, which is obviously very, very important. But an active strategy will be important to guide us through it. So where can people go to learn more from you?
So Pento Portfolio Strategies, it's pentoport.com is the website. I have a podcast that's $49.99 a year, which you get my high-level view like you've heard today. If you want me to manage your money and you have around $100,000, I'll put you in the IDEC portfolio myself. I manage that myself. I don't have a huge staff of people that I hire that go off on their own and do their own thing. So you'll be put in a Charles Schwab institutional account. I'll manage the money, and you'll be a part of the Paradigm template portfolio, inflation, deflation, economic cycle portfolio. The number here is 732-772-9500, and my direct email address is mpento@pentoport.com.
This discussion is for informational purposes only. Nothing in this discussion should be taken as investment advice. Guests are not compensated for their appearance. Do not base any investment decisions on the information presented.